David Orguttery is the Chief Executive Officer of InSource Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgell are financial advisors who represent Ameritas Investment Company, LLC, and Ameritas Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone. Today I'm here with Seth Edgell of InSource Financial Advisors for a discussion about dealing with economic uncertainties. With everything going on in the economy, market uncertainty seems to be top of mind for a lot of investors. Some people are nervous about volatility and wondering if now is a bad time to invest or even stay invested. So Seth, how should people be thinking about risk right now?
That's a great question, and honestly, it's one I've been getting a lot lately. Risk is always part of the equation when you're investing, but how we respond to uncertainty can make a huge difference in long-term outcomes. The key isn't to try and avoid all risk. That's nearly impossible. Instead, it's about managing risk in a way that aligns with your personal goals, time horizon, and financial situation.
So when you say managing risk, what does that look like in practice?
It means understanding where your vulnerabilities lie and then putting the right strategies in place to protect yourself. This could be through diversification, having the right insurance policies, setting aside emergency savings, or adjusting your portfolio as your goals evolve. A lot of times, market uncertainty triggers emotional reactions. People want to move everything to cash or stop contributing altogether. But that can be counterproductive. If your strategy is sound and built around your life, not just the market, then you're in a much better position to ride out the volatility.
You mentioned time horizon earlier. Why is that such an important concept for people to understand?
Time horizon is everything. It refers to how long you plan to leave your money invested before you need to start using it. The longer your time horizon, the more market ups and downs you can afford to weather. Historically, the S&P 500 has recovered from bear markets in about 2 years on average, according to data from First Trust and Morningstar. But let's bring that to life with a quick hypothetical example. Say two people invest $100,000. One plans to withdraw in 3 years, the other in 20 years. If a major downturn hits in year 2, the short-term investor may have to sell at a loss. The long-term investor, though, has time to let the market recover and even benefit from those down years by buying more shares at lower prices. Understanding your time horizon helps you decide how aggressive or conservative your investment should be. For a retiree needing income in the next few years, we might use bonds or dividend-paying stocks. But for someone in their 40s saving for retirement, they can usually afford to stay more growth-focused even in choppy markets.
So how does insurance factor into all this? It's not usually the first thing that comes to mind when people think about market uncertainty.
That's true, but insurance is a major piece of managing risk. Think about it like this. Your investment accounts are a way to build wealth over time. But if life throws a curveball like a disability, a major illness, or the need for long-term care, those same accounts might have to be tapped early or depleted entirely. That can set you back years or even derail your plan. That's where things like disability insurance, life insurance, and long-term care coverage come in. They act as guardrails. For example, if a family's primary earner becomes disabled and can't work, a disability policy could replace a portion of their income, allowing the retirement accounts to remain untouched. Or if a long-term care event arises in retirement, having coverage means you're not forced to liquidate investments in a down market just to cover care costs.
Well, that makes sense. So you're basically separating the role of protection from the role of growth.
Exactly. Not every dollar you have should be pulling double duty. We want some of your resources working to grow your net worth and others standing by to protect what you've already built. That separation makes your plan more resilient. Let me share a hypothetical case that illustrates this well. Imagine a couple, John and Linda, both in their early 50s. They're still working and they've got around $300,000 saved across retirement accounts. But they also have aging parents and college-age kids. They're in that classic sandwich generation. We run a risk assessment, and it turns out that if either of them were to become disabled, they'd have to drain their 401ks just to keep paying the bills. Worse yet, they don't have any long-term care coverage. So in their case, we might restructure things. We would possibly take out a moderate long-term care policy and adjust their disability coverage. We would probably recommend building a cash reserve so they wouldn't need to sell investments in a downturn. Because their time horizon before reaching withdrawal phase is roughly 15 years, we would probably recommend that a good portion of their investments remain growth-oriented, but we might reallocate a portion of those savings to defensive holdings to manage volatility risk. It's not that glamorous, but that kind of risk balancing can be the difference between having to delay retirement and staying on track.
You've talked a bit about diversification and asset allocation. Can you break that down a bit more for people who might not be familiar with those terms?
Of course. Diversification is basically the idea of not putting all your eggs in one basket. Instead of investing in just one stock or one type of investment, you spread your money out across different sectors, geographies, and asset types. So if one part of the market struggles, the other parts may help cushion the blow. Asset allocation is how you divide your portfolio between major categories like stocks, bonds, and cash. It's one of the biggest drivers of long-term return and risk. For example, a portfolio that's 80% stocks, 20% bonds will generally have more volatility, but potentially more growth than one that's 50-50. Over time, this balance should change based on your age, your time horizon, your income needs, and your tolerance for risk. At InSource, we use tools like Morningstar's Advisor Workstation and eMoney to model different allocation scenarios. That helps clients visualize what a certain mix might mean in terms of volatility, return potential, and even how long their money might last in retirement.
It sounds like you're encouraging people not to just think about the market, but their whole financial picture.
Exactly. Market headlines are always going to come and go. But if your financial life is built on a strong foundation with income protection, clear goals, an appropriate investment mix, and a good understanding of your timeline, you're less likely to make knee-jerk decisions that hurt you in the long run. The truth is, none of us can predict the market, but we can prepare for uncertainty. We can take steps to be financially flexible so that no single market event derails everything.
Well, any final thoughts for people feeling uneasy right now?
I'd say don't try to go it alone. Everyone's financial situation is different, and getting a second set of eyes, especially from a planner who understands your goals, can make a big difference. Sometimes just talking through your plan helps you see where you're already protected and where you might want to make adjustments. And ultimately, planning is about confidence. The more intentional we are with your strategy, the more peace of mind you can have, even when the markets are unpredictable.
Well, Seth, as always, thanks so much for this information. And for additional information, Seth may be reached through the means listed upon the following screen. For InSource Financial Advisors, I'm Brandon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritas Investment Company, LLC, member FINRA, SIPC, and Emeritas Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.